I see a lot of these challenges where people are investing £1, £5, £10, whatever reasonable amount of money into the stock market, or gold, or this or that. Anyway, people seem to love them, and I think it's for two reasons. One, it's an accessible goal. £1 a day is £30 at the end of an average month, so it's not absurd to be saving that much, but it still feels like something. Two is increasing the pot daily feels like you're building to something and you don't have to wait until the next month for the next deposit. In other words, it's something interesting each day. Now, I am a content creator, so inevitably I have to take it way too far just for the sake of views, so I took it a step further, well, 2 or 3 powers further actually, and decided to go for £1,000 a day. You know, the ancient Buddhist saying, go big or go home. In this video, I'll explain what happened and also why I will never do it again. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only and should not be considered investment advice or investment recommendations. Whenever you invest, your capital is at risk. Why did I do this? I got invited to join TikTok by a rep. Supposedly they wanted people who have over 10,000 YouTube subscribers or 100,000 Instagram followers to join TikTok and do some kind of daily posting challenge. And, full transparency, they pay some money for you to do this challenge as some kind of signing up bonus, but there are a load of terms and conditions and ifs and buts and loopholes. And I don't think TikTok or short form fits the Dividend Experiment channel really. I think there's a lot of nuance on investing topics, and that can't really be learned or explained in the short time you get in a TikTok. But anyway, let's not go down on that tangent right now. So I started this challenge on a new TikTok channel, thinking about posting it every day. To make it more interesting, I introduced another part of the concept where viewers can post the tickers of stocks and vote for the ones they like, and then I'll buy them and add them to a special pie just for the series to do some comparison. It was a good idea, but TikTok thought I was scamming, so it restricted the views, and it never really took off. So that's the background, let's get to the actual point. As you probably know, unless you've been living under a rock, the S&P 500 has not been doing that well so far this year. At the time of making this video, it's down 6.39% year to date, and by the time you're watching it, probably even lower. So naturally, the £30,000 invested over 30 days was also down. Not sure what you're expecting really. But here's the result of the £30,000 invested once per day, well, days the stock markets are open. And if I'd have invested all the £30,000 at the beginning of the series instead of daily, then the portfolio would be down 9.67% instead of 7.77%. So if it reduces the percentage of losses, why will I never do it again? The reason can basically be reduced to, it went well here in this case because the market was trending downwards. It would have been the opposite if the market was trending upward. And the market has historically trended upward over the long term. Why lump sum investing usually outperforms dollar cost averaging. The logic behind lump sum investing is rooted in one of the most consistent patterns in financial markets. They tend to go up over time. When you invest a lump sum, say £30,000, all at once, you're giving your entire portfolio immediate exposure to the market. And that means every penny starts compounding right away, taking full advantage of any upward movement in prices, and when you're investing for the long term, that head start really matters. The market's long-term direction. Historically, stock markets have gone up about 70 to 75% of the time when you look at annual returns. The S&P 500, the most tracked US index, has delivered an average annual return of around 10% before inflation since 1926. The FTSE All-Share in the UK has similarly returned around 7 to 8% per year over the long term. Even when you factor in bear markets, corrections and crashes, the trend is still upward because companies grow, economies expand and innovation drives long-term value. So if you're sitting on cash waiting for a better time to invest, you're likely missing out on positive returns. The Vanguard study. One of the most cited studies on this topic comes from Vanguard. They compared lump sum investing with cost averaging across various time periods and countries, and here's what they found. In the US market, lump sum investing outperformed dollar cost averaging in about 68% of scenarios over a 10-year rolling window. In the UK, lump sum beat cost averaging in about 67% of cases. In Australia, the number was 66%. They tested this by taking hypothetical investors who either invested all their money at once or spread it out evenly over 12 months, then compared the performance after the full period. The takeaway? 2 out of 3 times, lump sum wins, and in 1/3 of cases where cost averaging performed better, it was usually by a smaller margin than lump sum's advantage in its winning scenarios. Power of time in the market. Compounding is the key reason why lump sum tends to outperform. The earlier your money is invested, the longer it has to grow. And let's say you invest £10,000 a day versus spreading it out over 12 months. Even if the market drops slightly after you invest, if you plan to hold for 10 to 20 years, that initial dip barely matters. But every month you delay investing, part of that £10,000 is a month it's not growing. But what if I invest and the market crashes? And that's the fear that keeps people from lump summing. What if you invest £30,000 a day and the market tanks tomorrow? It is a fair question, and there are rare cases where dollar cost averaging performs better in the short term, especially during extreme downturns. Take 2008 for example. Investing a lump sum in October 2008 would have meant watching your money drop by another 20% in a matter of weeks. In that kind of environment, dollar cost averaging would have felt safer and potentially performed better. But here's the key. Those situations where cost averaging works better are exceptions, not the rule. Most people can't predict crashes. Most people aren't investing for 3 months, they're investing for decades. Even if you invest right before a crash, markets usually recover within a few years. Case in point, if you lump summed in October 2007, just before the 2008 crash, your portfolio would have been underwater for a while, but by 2012 you'd be back in profit. And by 2020, you'd be well ahead. In the long game, time smooths out bad timing. So why are there so many £10 a day challenge type videos and TikToks? If you spend any time on TikTok, Instagram Reels, or even the Trading 212 Pies, you've probably seen them, the £10 a day investing challenge videos. Someone decides to invest a small amount daily for 30 days and post their progress, complete with colourful charts, emotional ups and downs, and a final reveal at the end. I made £14.73. Or I lost 3.5%, here's what I learned. But while these videos are everywhere, and they're rarely about smart investing, they're about engaging content. Here's why these challenges have taken over financial social media and why they persist despite being ineffective as actual investment strategies. Firstly, they're easy to understand and easy to copy. Most people are not finance nerds, they're regular people who want to feel like they're doing something good with their money. And that's what makes the £10 a day challenge so effective. It's simple, tangible and repeatable. You don't need to understand index funds, ETFs, diversification or compound interest to follow the story. You just need to know £10 every day into something that grows, hopefully. That simplicity is key. Complex financial concepts don't spread easily on social media, but this, anyone with a spare tenner and phone can replicate it. It lowers the barrier to entry, not just for investing, but for making content about investing. It's also a great hook. I invested £10 a day for 30 days. Sounds like a clear narrative. It invites viewers in. You kind of know what you're expecting going in and curious to see how that ends up. And speaking of hooks, I even stole this exact title of the video you're watching now, well, almost the same, from Mitch. And probably so did this guy. Probably some thumbnail inspiration going on here too. And maybe Mitch himself was inspired by this or any number of other variations of this general theme that there are on YouTube now. Anyway, you get the idea. It's a concept that's done to death, but it gets views, so people love to make these types of videos because they're great for engagement and algorithms love it. These challenges have a natural episodic structure, day 1 to day 30. That gives creators a built-in content calendar and audiences a reason to keep watching. If you do it daily on TikTok or Shorts or Instagram or something, then there's no need to think of new ideas every day, and editing is way easier. Then at the end, you can make a whole video like this one that gives the audience a kind of debrief after the month. It taps into the same appeal as fitness transformation vlogs, no spend months or 30-day productivity sprints. There's a clear beginning, a middle, and an end. From a content creator's perspective, this is gold. Frequent updates drive views and comments. Viewer curiosity builds over time. How much will they make? What's the total at the end? Engagement spikes as people offer advice, feedback, or argue over which stock or ETF they should have chosen instead. Social media algorithms reward this behavior, and the platforms push content that people interact with, and investing challenges are built for interaction. They're not just personal finance, they're storytelling, and the market just happens to be the backdrop. But storytelling type content is fine because the challenges feel empowering, even if the actual impact is minimal. For a lot of people, investing feels intimidating. Headlines scream about crashes, volatility, and inflation, and the idea of dropping £5,000 into the market all at once feels pretty reckless if you're not used to it. But £10? That feels manageable, and that's probably how much a pint of beer costs in London now anyway. These challenges give people a sense of control, even though the actual financial impact is relatively small. 30 days of £10 would just be £300 over the course of a whole month. It feels big because it represents a shift in mindset. I'm not just spending money anymore, I'm building towards something. Therefore, in my opinion, it's more about behaviour than portfolio size or returns. These videos and challenges aren't really about maximising gains, they're about proving to yourself and followers that you can commit to a plan. And they deliver instant psychological wins, discipline, consistency, and a visible routine. It's investing as habit formation, which is great. But importantly, it's not the same thing as the effective portfolio strategy. In fact, it's more of a starting point, less of a strategy. And this is where the disconnect happens. A lot of creators and viewers treat these daily challenges as if they represent an investing method, something to be optimized, analyzed, or followed religiously. But they're not. They're on-ramp content. They serve as the first step for people who've never invested before. And in that sense, they do have value. They demystify the process, get people to open a brokerage account, and reduce the fear of just getting started. But long-term investing isn't about what happened over 30 days with £300, it's about what happens over 30 years with as much capital as you realistically put to work. Challenges like this are great for building confidence, but they can also give a false impression of what real investing looks like: boring, diversified, and automated as much as possible, and mostly hands-off. If someone walks away from one of these challenges thinking they've tested investing and now know what works, that's kind of misleading. It's like doing a 10 push-up-a-day fitness challenge for a month and assuming you're ready for the Olympics, and wondering where your six-pack abs have got to. Then finally, low fees make it possible, thanks Trading 212. Now, one big reason why these kind of daily investing challenges are even possible, especially the £1 a day or £10 a day style, is because platforms like Trading 212 exist. There are other low-cost platforms. In fact, I have a whole spreadsheet of them with pros and cons in the Dividend Temple Discord. I'll just use Trading 212 as the example here, as it's what I use for the challenge. Back in the day, if you tried to do something like this with traditional brokers, you'd get absolutely rinsed by fees. I'm talking £5 to £10 per trade minimum, which would completely destroy any return you'd make on a small daily investment. Imagine putting in £10 and losing half of it just to place the order. No thanks. But with zero commission trading, a low 0.15% FX fees on fractional shares, and the ability to build custom pies, Trading 212 makes it actually viable to invest small amounts daily without the platform eating your returns alive. It's not just about low fees either, it's the accessibility. Fractional shares mean you don't need to wait until you've saved up £300 to buy one share of something like Microsoft or Amazon. You can just toss in a few quid and still get exposure. And that's a big part of the reason these challenges have taken off. It's not just people copying each other for content. The infrastructure now exists to make this kind of micro-investing frictionless. If you tried to do this challenge 10 years ago, you'd either be laughed out of your broker's office or you'd go broke on fees before day 10. So what's the conclusion? If you're sitting on a large sum of money trying to decide whether to invest it all at once or drip feed it in slowly, the data is pretty clear. Lump sum investing almost always wins over the long term because time in the market is what really matters. If you see something popular on social media, then it's probably just because it's popular on social media, not that it's genius advice that should shape how you invest. Of course, this is a pretty benign example of social media influencing investing, but important to remember that good content for views and good investing doesn't necessarily align. What are my thoughts on how often you should invest? Well, I've been pretty pro lump sum for a while, so my general thoughts on it is to make a budget plan for when you get paid, include some percentage of your income as investing allocation along with bills, rent, etc., etc. Invest it pretty much as soon as you get paid, like it's a bill due on that day. No funny business about holding it for the next week or splitting it up into daily increments. And if you get paid monthly, invest monthly. If you get paid weekly, invest weekly. Anything else is probably overthinking it. Disagree with my thoughts here? I'd love to hear why in the comments or in the Dividend Temple Discord channel. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!